Welcome back to Trendlines over Headlines, the show where we break down the markets with some of the best traders and analysts in the world. My name's Patrick Dunawilla. I'm the editor of the Chart Report, and I'll be your host today. Our guest is none other than Chris Verrone. Chris is a partner at Strategas, where he's also in charge of the firm's technical and macro research. He's one of the top macro analysts on Wall Street, according to Institutional Investor magazine, and he's frequently quoted all over the financial media. But before we talk to Chris, it's Friday, the markets are closed, so let's take a quick look at how this week played out. Hey guys, thanks for watching. Just a quick reminder, be sure to click like and subscribe so we can continue bringing you awesome content. Thanks. All four major indices closed higher this week. The Russell 2000 led, rising about 1.5%. The NASDAQ lagged. It barely closed higher, and it was more or less flat on the week. But it led by a pretty wide margin the past few weeks, so it's nice to see small caps take the reins for once. You know, for the past couple weeks, we've been saying that small caps really needed to step up to the plate here as the Russell 2000 was skating on thin ice. So it's constructive to see them leading for once. Taking a closer look at the S&P 500, we closed higher on the week by a little less than 1%, but it still hasn't been able to breach that 4,200 level. So that's definitely the next upside objective for the bulls. Now, taking a quick look at sector performance, financials actually led this week, rising more than 2.5%, thanks to some of those post-earnings moves we saw here on Friday. On the other hand, real estate and utilities were the laggards, with both falling about 1.33% on the week. Anyway, that's enough from me. Let's talk to Chris. Chris, welcome to the show, and thanks for coming on today.
It's great to be here. Thanks for having me.
Of course, a huge fan of your work and the work you guys do over at your firm, Strategas. So thanks for letting me pick your brain here today. But we've got a lot of charts to cover, so let's dive right in.
Sure.
Let's kick it off with the S&P 500, shall we?
Yeah, sounds good. I mean, we're right back to the top end of the year-to-date range, and I think there's a sense out there that this rally, there's a lot of FOMO behind it. And what I want to just maybe start with is taking a look at under the surface. What are we seeing in this move the last 3 or 4 weeks relative to what we saw earlier this year? And, you know, there's certainly some good things going on, but I also just want to be mindful. It is not as broad as perhaps the move we saw January, February. I think February 2nd, you know, S&P is roughly 4,200. You have like 80% of issues above the 200-day. That number is a bit more restrained here. It's about 55 to 60%. So I don't think that's the end of the world, but I think at a minimum, it does describe a very, very split market where basically sector by sector, I can give you things I like and things I don't like. And that can be a very frustrating or paralyzing environment for many, but I think it's the fact of the day, and that's how we must proceed.
Yeah, I'm glad you brought up breadth there. I mean, you know, market leadership has been kind of a concern right now. And you keep hearing, you know, it's just a handful of stocks doing all the heavy lifting. And I'm wondering if, you know, when you look at the data, when you look at the action, is that what you're seeing as well? Or do you think those fears over, you know, some of those mega caps doing all the heavy lifting, are those fears just kind of overblown?
You know, I think that's a little overstated. Certainly the top of the market has driven a lot of the returns this year, but you know, just kind of going sector by sector, whether it's discretionary or whether it's industrials or whether it's tech, there's good and there's bad. And this is a market that I think splits, you know, one of two ways. What I think is important, though, I'd say on balance, the leadership is probably more defensive this time around at 4,150 S&P than we were in late January. And, you know, a couple exhibits that I think speak to that. On one hand, I like to look at discretionary versus staples. We equally weight it. So it's not Amazon versus Procter & Gamble. It's what is the average consumer discretionary doing relative to the average consumer staple. That's softer than it was in late January, early February. We have certainly seen pockets of discretionary, I think, weaken here. We know the weakness in small versus large. That's certainly been on display basically since the revelation of some of these banking issues in early March. Other pairs or relationships that I would certainly speak to, transports. I mean, even today, with market up a lot, transports were soft. I look at transports versus utilities as some proxy for economic cyclicality. Here's EEM versus S&P. That's been a little bit more mixed. But I'd say on balance, Patrick, that the leadership reflects a more cautious tone than perhaps the more cyclically driven performance that we saw in late January, early February. I was thinking about this last night. This is a market that you can really choose your own adventure, right? So behind door one, you have the 2-year yield, 100 basis points below the Fed funds rate, gold at a new high, and banks that haven't bounced. And behind door two, you have Apple near the highs, LVMH at a new high, and home builders continuing to hum. So I don't know how long we can coexist with all those competing messages, but we're certainly coexisting with those competing messages right now.
Yeah, I mean, it certainly seems like some of those mega cap stocks did act as almost like a safety trade. And you brought up LVMH. I know you and Todd at Strategas, you guys are always looking at European luxury stocks. What's the reason for that? And what does it kind of tell you? How do you?
Yeah, well, I mean, it's if you look at LVMH, it's one of the largest weights in Europe. It's, I think, just as important as looking at Apple or Microsoft here. It's the largest weight in the French CAC. And it's a reason why the French CAC is at new all-time highs. And, I was saying in a meeting today, been doing this 20 years. I can't remember in 20 years, French CAC making a new high before S&P or NASDAQ did. So I think at a minimum, one would say that's a little bit of a different regime. I go back to last year in a down market, Europe largely outperformed despite all the kind of negative headlines. And thus far this year, in what has largely been an up market or a risk-on type market, and Europe is we've also outperformed in that part of the world. So you look at that combination, and at what point are you just going to call it leadership, right? Outperforming in an up market, outperforming in a down market, that kind of sounds like leadership.
Yeah, and you mentioned it's kind of choose your own adventure. There's some positives and negatives, but I'm wondering, is there anything in particular that you'd like to see right now, whether it's a level or an indicator or industry group leading? Is there anything that you'd really like to see that would get you more bullish?
Well, I think, when I think about my work historically and both good calls I've had and bad calls that I've had, they've never been particularly level based. They've always been, what is the character of the market? What's the character of leadership? And I generally put myself kind of more on guard or more defensive when leadership looks tepid. And I think on balance, leadership is fairly tepid. Doesn't mean the market can't go up. I mean, I'm very reminded of like mid-06 to mid-07, you had very defensive leadership. 2019, you had very defensive leadership. It didn't prevent the index from going up. When I look at the kind of composition of the tape, it would be foolish, I think, to describe this as anything greater than a very split market. And we see it in the new high data, right? We've had a very big move in S&P right back to the top end of the range without some, broad expansion in new highs. So let's not lose sight of that. What I would say, maybe from a macro perspective, if this is going to be, a directional move higher for the next number of quarters, I actually would want yields up, not yields down. I know that probably sounds counterintuitive. I don't like 2-year yield below Fed funds, and two's at, roughly 4%, Fed funds at 5 is an environment where you've had to watch your back historically.
Yeah, and I want to ask you how the Fed and liquidity kind of fit into your market outlook here, and how do you kind of incorporate those with the technicals?
Yeah, well, I think kind of rule one in this business is when you listen to or watch the Fed, more importantly, ask yourself, is the market justifying what they're saying? I think we had Fed minutes yesterday. We had a number of Fed speakers come out with some iteration of the banking system is sound and resilient. Maybe, but then why can't the bank stocks rally? And that's been my other issue here. It's like, I get it. The acute phase of the banking crisis may have passed, but I'm also struck by a lot of these regionals and community banks are a couple days removed from 52-week lows. You think about the rally we've seen in S&P. S&P's retraced, I think, 80% of the decline since early February. The banks have retraced 10% of the decline. I mean, even after Bear Stearns in 08, you got a pretty good rally in banks. certainly after LTCM in 98, you got a very big rally in banks. So I am a little off put that they haven't worked here to any, meaningful extent or great degree. So we like to look at, things the Fed may say are right, and then ask the more important question, does the market agree?
Yeah, and I'm glad you brought up banks there, because that's kind of my next topic. It seems like the whole banking crisis came and went with no major consequences. I mean, yes, a few banks blew up and stuff, but in terms of the broader market and even the economy, it really doesn't seem like there was much hiccups. But at the same time, they're still, like you said, kind of hovering right near their lows. You haven't even really gotten a dead cat bounce. So do you think they're kind of due for a bounce here? Or, I see some RSI divergence there. Yeah. Would you expect a bounce here, or do you think, it's not even worth trying to look at there?
We're on the eve of bank earnings, right? And certainly who am I to say they can or they will or they won't? But I am struck that they haven't yet. I would say it extends beyond just banks, which I think is interesting, right? The insurance names don't act particularly well. The public private equity names, thinking like Blackstone, Carlyle, don't act particularly well. I always look at BlackRock as kind of a proxy for the index at large. I mean, I think BlackRock has the highest correlation of any stock in the S&P itself, about 0.85 or so over the last decade. Yeah. So, I mean, think about BlackRock, it is the index, right? I think BlackRock is a top 2 or 3 holder in about 95% of US equities. So it should be the index. The rally in BlackRock's been underwhelming relative to the rest of the market. So I look at some of these as proxies and say, okay, if this is just a contained banking issue, then why did the insurance names sell off? And why have the brokers sold off? And why do the public PE names trade poorly? So I know I don't know. And that's the first rule of this business. We know we don't know. But there's a few things that just seem off in that sector. I'd be more inclined, if you got some type of earnings move or earnings rally, to be a seller of that move, not a chaser.
Yeah, and there's tons of focus on the banks, but you look at XLF, and I don't know if you saw, but they recently added Visa, PayPal, MasterCard, these things that used to be in the tech sector, and I never really understood why, but they added them in there right as financials are skating on thin ice, right at that, XLF is at that 30, 31 level. It seems like everybody and their mother is watching that chart and that level right now. And it is really important. So I'm wondering what you think of that and some of those recent.
I think in some perspective, the inclusion of, MasterCard or Visa into financials, it has given a place for maybe some of the bank people to hide out. And I think that's reflected on both of those charts. I think both were on the breakout list today. So I certainly don't want to stand in front of strength, and you have that in MA and V. But that's about it, kind of go name by name in financials. I think we counted last week, 125 Russell 3000 banks were on the relative low list. So even those that have stabilized haven't really shown any gusto or any umph on the relative side of the equation.
Yeah, so it's really not just regional banks. It's kind of all of those other components in there, or all those other industry groups within there. Is that what you're saying?
Yeah, I mean, it's big and small. I mean, everything from JP Morgan all the way down to the small community bank that you never heard of has largely not shown any relative oomph, these last 2 or 3 weeks as they've attempted to stabilize. And I would watch the insurance names in particular. I mean, these were leaders for a long time. I think a lot of money has camped out in insurance. I mean, they're leaders within financials, but they're no longer leaders within the context of the broader market. And that's a bit of a change for that group.
That makes sense. Well, Chris, I know you do a lot of work on rates, and you briefly touched on them earlier, but I want to kind of dive further and get your outlook here. They're obviously driving a lot of the trends we're seeing, whether that's banks and financials or tech, utilities, commodities, or even some of the fringe assets like Bitcoin. But we've been flirting with this 3.4 level over the past few weeks. And do you think the 10-year yield ultimately resolves higher or lower from these? So in the near term, maybe the next 3 6 months.
My cyclical suspicion, kind of my near term, let's say 3 to 6 month suspicion on yields is lower. Now, I got to be careful here, because I do think we are in a different type of secular regime in yields than we've seen in some time. And I probably don't want to overstay my welcome on the long side of the bond trade. But when I look at the leadership, we talked about, small, large, transports, utilities, discretionary, weaker than staples. I mean, that's leadership that historically has been supportive of yields down. So I don't want to kind of lose sight of that message. What's most important for me, and I think we have the slide, is if you look at the curve, the entire curve is below the Fed funds rate. So whether you're looking at 2-year yields or whether you're looking at 5-year yields or 10-year yields or 30-year yields, the entire curve is below Fed funds. I think the slide you bring up right here is interesting, though. There's this sense I've just gathered from meetings that clients and investors are like almost eagerly anticipating the rate cut part of the cycle. And I think you got to be a little careful of that. History argues that's actually not something to celebrate. Pauses have historically been bullish. And, maybe we're in the pause part of the market here. But the cuts have historically not been bullish. So I show you two of the more recent historical examples. Nikkei versus BOJ in 89, 90, 91. You got a very big rally. Nikkei rallied 35% when BOJ paused in mid 90 and early 91, but the bear market resumed on the cuts. And very similar with NASDAQ in 2000, 2001, very big rally on the pause, like up 35, but then trouble resumed on the cut. So, be a little careful what you wish for. I don't think the quote Goldilocks financial crisis or perfect financial crisis really exists, where you get the Fed to back off, you get inflation to back off, but you don't hurt earnings, right? That's maybe a lot to ask for.
Yeah, that's really, really interesting. And it kind of gets back to what you were saying about how you'd like to see rates higher here for the broader market. And I think that's a pretty unique view right now. I don't think that's consensus. Would you agree?
I think so. Where I would add to that is I think people want the curves to steepen. And I would say, be careful what you wish for. Like we can survive with an inverted curve. It's when the curve begins to come out of inversion is where, frankly, your problems have typically emerged. Like that's the last step on the path to recession. Here we show, 210s, like steeper curve is what gets you to recession. So I just want to be a little bit mindful of that. I can deal with an inverted curve. You've had some very good equity rallies with an inverted curve. I'm thinking 1979, you had about a 30 or so % rally with an inverted curve. Obviously mid 06 to mid 07, you had about a 25% move with an inverted curve. So you can live with an inverted curve. Leadership tends to be more defensive, but you can live with it. When that curve comes out of inversion, kind of got to watch your back.
Yeah, I think that's a really interesting point because, every time it has inverted, or at least in my career, which is only a handful of times, it seems like everybody freaks out. And then the lag time. It's usually at least 9 to 12 months or probably more than that, maybe 9 to 20 something months before you do see the recession. And what you're saying is watch for the curve to uninvert. That's the real trouble.
Yeah. I mean, we recently did some work looking at kind of analogs that may speak to this a little bit. And I was drawn to this kind of post-World War II, 1946 to 1950 analog. I don't have a chart to show you on this yet. It's kind of new in the gestation period in our minds. But when you look at that period, when you hear trading range, most people think of 1970s, but the original range is the range from kind of 46 to 50. I mean, you had a violent up 20, down 20, up 20, down 20, about 4-year range there coming out of the war. You had very volatile inflation backdrop. If you read any of the literature from those kind of 4 or 5 years, you had the economists all expecting recession, waiting for it, waiting for it, waiting for it, waiting for it. It ultimately came, but much later than people thought. I think the recession is 1949. You wind up retesting the 46 lows in 49, but actually not making a new low. I can just draw a lot of parallels to kind of this waiting for Godot recessionary kind of quasi-recessionary environment that we've been in over the last year. The parallels with that 46 to 50 period, I think are pretty relevant.
Yeah, and I'm really glad you brought that up because I actually had that on here. I know you're a big fan of market history, and that's interesting that you think that's kind of a better comparison because I think the obvious one is the 70s,
right?
You have the high
I think we got to be a little careful with marrying analogs. And I think you see
Right.
that in this business a lot, right? It's not April of 1948. It's April of 2023.
Right.
And
Or it's 2008 all over again.
It's not summer of '08. It's spring of 23. And it's not, June of '01, which is another popular one right now. It's, spring of 23. So we can learn little clues. And that's our goal, I think, or the goal of my work is to kind of accumulate all these clues and all these puzzle pieces and just kind of see what the puzzle may look like. I think at times you can have competing theses, and the market will determine, which of those two theses will be correct. As we kind of started the conversation today, like on one hand, bond market and leadership looks pretty defensive. On the other hand, LVMH is at a new high and NVIDIA won't go down. So you can
choose your own adventure, right?
You can choose your own adventure, so to say.
Well, so in that choose your own adventure type environment, it's obviously pretty challenging. This isn't 2017 where it's just this steady bleed higher, no volatility. So, one of the pockets of strength now is all of a sudden gold, right? Here we are knocking on the door of all-time highs. We're above 2000 and it really looks like it wants to do it. What are your thoughts on gold? Do you think it'll ultimately break out and hit those all-time highs?
So
we're right there, pretty much.
We're right there
tomorrow. Yeah.
Yeah. We got very lucky. And I said it humbly, we got very lucky with a gold call in late September. I think September 29th, we wrote a note called The Contrarian Case for Gold. And just anytime you hear a sell-sider say, the contrarian case for something, it means that we're too afraid to say go buy it. So we need some cover if it doesn't work out. And
that's good to know.
Fortunately, it's worked here. I think the question is at what point is it crowded or overowned? And that's where we can use the positioning data to kind of gauge that. I would say positioning is up modestly. I wouldn't say you're in that like 90th or 95th percentile nosebleed where things get too crowded. I like the fact that gold's made new highs in almost every other currency I can find. I mean, good bull markets make new highs in any currency you own them. Gold checks that box. What I find particularly curious, here we are, I think yesterday, right, was the 6-month anniversary of the S&P low back in October. So we're 6 months off the S&P bottom in October. Hard to find many examples historically where gold's up more than stocks 6 months off a low. This is one of them. And really difficult to find, just back to the bank conversation, examples historically where 6 months off a low, banks are down. That's just, don't like to use the word unprecedented because we only have 100 years of financial data. Maybe 200 years ago, something was a little different, but in the body of the data that we have, very, very rare to see gold up more than stocks 6 months off, 6 months off a low, and banks down in that same period.
No, that's an excellent observation. And I want to see where you're going with this.
Yeah. I mean, I think at the end of the day, you can kind of hold my feet to a target on gold, but my answer is just going to be higher. I like trends, and the trend in gold is up. I think the difference between the failures at these levels in February, March of 22 and maybe April, May of 20 was positioning was just too aggressive. And I don't think that's the case today.
Yeah. And I'm so glad you brought up positioning and kind of sentiment on gold, because we're all seeing that gold chart. Everybody is watching for that breakout, and that tends to concern me, at least. Probably you the same, when you see so many people watching the same movie, basically. And while everybody's watching it, it doesn't seem like people are positioned in their portfolios for a bull run in gold. But you mentioned something about positioning there. What are you seeing from the data?
Well, I'll make 2 points. I would generally agree to the extent that people haven't had to own gold. I mean, gold was not something you were rewarded for during the QE regime, right? QE was about financial assets, not hard assets. So there's a whole, I think, generation of money managers that have never had to make money in gold. You kind of have to go back to, I guess, 02 to 06, maybe 03 to 06, kind of the last period where it really worked. Curiously, when gold went up in that stretch, real rates also went up. There's this view out there that gold can't go up if real rates are rising. The early part of the aughts would actually dispel that myth. And one of my favorite things about this business is dispelling myths, right? You hear all these things that, oh, this can't happen, or this. Well, let's go back and look at the data. '03 to '06, real rates up, gold up as well. If you start with like the basics, CFTC, commitment of traders, positioning's up. It's not like you're in the basement, but it's not in the same aggressive territory that we saw that coincided with prior blowoffs. So we've had a very big move in gold in a short period of time. We took it from 1,600 to 2,000 and change. I would be reluctant to call it a blow off yet. The question I get asked all the time is, and maybe this comes as a surprise, maybe it doesn't, but 99% of people I talk to every day are fundamental investors. I don't think I talk to anyone who really does charts for a living. And the question I guess, well, Chris, what's the fundamental case for gold? I have no idea what the fundamental case is for gold. And I think by the time you figure it out, the move's typically over. Gold has a funny way of telling you something or attempting to tell you something. And then by the time you really figure it out, it's too late. So I don't want to figure it out. I'm perfectly content with the articulation that gold up probably means dollar down. We'll leave it at that for now.
Yeah, it's an extremely emotional asset. And, on that vein, and before you go, I'd like to get your thoughts on digital gold, Bitcoin, cryptocurrency, because I think you could say the same thing there, right? What's the fundamental case for Bitcoin, Chris? It's kind of hard to come up with one, right? It's an emotional asset. It's.
I think anyone's guess would be as good as mine on that. There's not. Someone told me one time there's nothing more frustrating than watching people make money and stuff that you didn't think was worth your time. I'm a little bummed because I didn't think Bitcoin was worth my time a couple months ago when it started to bottom. So I'm watching it move against me here. Intellectually, I get it. I get why it works here. But I don't know what's more important. The fact that it's up, almost a double or so off the lows. It's called 89% of the lows, or that it's still down 50 from the highs. And I think, that's the left side of the Excel sheet and the right side of the Excel sheet. Which column is more important? Where gold, it's clearly an underperformer relative to Bitcoin, right? Bitcoin's nearly doubled, but gold's at a new all-time high. So again, what column on the Excel sheet is more important? The last 3 months or the last 5,000 years? And one of those two assets is at a 5,000 year high and one's not.
Yeah. I think we're all trying to figure out what this thing really is, right? And nobody really knows for sure. Sure, there's the Bitcoin maximalists and stuff like that. They might know a lot about it.
What we do know though is historically, things that survive multiple 80% drawdowns tend to be survivors.
Right.
So Bitcoin has now survived 3, I think, 70+% drawdown. So I kind of have to tip your hat in that sense that it survived that stuff.
Right. It isn't going away.
All of those drawdowns have largely occurred in the kind of same monetary regime. So, we'll see how a couple cycles treat it. But who am I to be an arbiter of what should or shouldn't work?
Yeah. And it really has been working this year, but here we are at that 30,000 level. Would you expect at least a pause here or?
So we're basically approaching the 50% retracement, I suppose, of the high. I did think notable Coinbase has not made a new high with Bitcoin here. A couple divergences like that, but I'll take a pass. I have no edge.
That's quite all right. And last question on it. We saw it trading so correlated. It was so correlated last year with specifically the NASDAQ, but really stocks in general. Do you think that was a case of, you've heard the adage, in risk-off environments, correlations tend to go to 1. Do you think that was what was going on there? In a risk-off environment,
it's a good
everything
question.
Was just going down together.
It was a
longer term.
2022 was a very monolithic year. Not just Bitcoin and NASDAQ, but almost everything was monolithically related. Most things were down, energy notwithstanding, maybe rates notwithstanding. So I'm not sure NASDAQ and Bitcoin or S&P and Bitcoin are really correlated. We're just confusing a year's worth of data where everything was kind of correlated. And it's one of my pet peeves in this business where like people showed me charts of last year with two lines on the same chart that look like the exact same thing. Well, everything looked like the same thing last year. So I'm not sure there's any great, intellectual revelation from that. I think last year was about high correlation. This year seems to be about high dispersion. I think those are two very, competing concepts. When I go sector by sector, looking at the equity market, there is such intense dispersion between, frankly, names that do roughly the same thing. I mean, look at like global autos. Are you bullish or bearish on global autos? Well, GM, I'm pretty bearish. BMW, I'm pretty bullish. So what's the call? Right. And you can do that group by group, sector by sector, stock by stock.
Yeah, I mean, I think that's a really interesting point. They're not getting too kind of caught up with those intermarket correlations. And thank you for letting me ask you about that, by the way. I know it's not something you focus a lot on in your work. I know your clients aren't calling you up and saying, Chris, what do you think of Bitcoin here? Maybe they are.
You'd be surprised. That's a lot of calls.
Well, Chris, I think we got to leave it here for today, but thanks for coming on, and I hope to talk to you again soon.
My pleasure. Thanks for having me. Talk soon.
Thank you guys for watching. If you enjoyed the show, be sure to click like and subscribe, and we'll see you again next week. Thanks.